Hello everyone, welcome to this week's JCF Weekly. So what's Bitcoin got to do with me? In today's episode, we'd like to discuss a topic is how can retail investors protect themselves against, investment risks. First question we have to, discuss is what are some of the risks for individual or retail investors? This is compared to like big institution investor who have big money. So for most of us individuals, we probably only have some money to spare for investments. Now, there are mainly two risks that retail investors would face. The first is lack of knowledge, proper knowledge, in terms of choosing the right investment vehicle. Okay, so with a comparison, everyone knows about Warren Buffett, one of the most famous and also who has the best performance investor in the world. What Warren Buffett does is he looks through the company's info and also their financial data, from company A to company Z. He basically reads that as his pleasure and as what he enjoys to do. So he can gain very deep insights about the basics and the fundamentals of individual companies. And he bases investment decisions mainly on that. Okay, so what happens is with someone like Warren Buffett, he is definitely sure which companies are good long-term investments to hold for. But for most of the rest of us, we may not have the time, the knowledge, or the interest to dig into all the basic fundamentals in order to find the right investment vehicles. Okay, so what retail investors do is they read the news, they listen to someone from friends or relatives, or they might, listen after some investment gurus. But they don't really do the homeworks themselves, and they don't really have the time or the expertise to actually comprehend many of the, what's actually required into going to choosing the right investment vehicle. Now, the second type of risk is actually a lack of discipline. So we all know that whether you're an investor or maybe a trader, timing is usually very important. But this is the part where most retail investors do the poorest. Because usually due to greed or fear, what happens is, when the market is going up, then everyone starts to go purchasing. But you could potentially purchasing at a high price compared to its actual value. And when everybody's selling off, when there's a big fear, then out of fear or loss, you would also sell your assets or sell your investments, again, not at the right time, and maybe potentially at the loss. So this is why, due to lack of, proper selection of the investment vehicles and also lack of discipline, this is why most retail investors don't really make any money from their investments. Now, how can we address this? For the problem of lack of, selecting the right vehicle, there's actually a proven approach called index investments, which simply means that instead of choosing and picking individual, company stocks or investment assets or vehicles, you invest into a whole class of assets or like companies. So in the US, there's what's called S&P 500, which is just the top 500 companies that's, being selected by the organization S&P, Standard & Poor's. So if you invest into the S&P 500 with an index approach, essentially you are taking investments in a piece of the company, all of them. So what this does is you're actually investing in the trend, the growth of the economies or of all the companies, instead of relying on the success of any single individual assets or companies. So that's a much more reliable approach than selecting by yourself. Now, for the lack of discipline, there's also some very simple ways you can protect yourself. For example, if you just set up certain rules, then once you have certain profit, then you just take the profits out and then don't touch it again. Okay, that would probably, prevent you from selling to, at the wrong time. And if you're worried about going into or buying at the wrong time, then there's a very simple way is to just invest at regular interval. Just put the money in at regular times. This will prevent you from missing out. Now, so these are very simple techniques. Once you have the rules in place, ready, just execute them. Okay, just invest at regular intervals and also take the profit out once they hit certain performance target or metric, and then don't touch the profits unless you are using it for reinvestment purpose, again at regular intervals. So these are all very simple ways you can do. Now, one last thing we like to share is that how we at Joint Commonwealth Fund, or JCF, is doing this to help retail investors. JCF is a crypto index fund by design, and so it's investing into the crypto trend of the next 5, 10, or 20 years. What happens is, if you believe or if you think that cryptocurrencies or blockchains are something on the rise, then the easiest and also the safest way to invest, to take part on, is actually through index investments. Okay, so in that way, you don't have to survey or study or investigate which individual cryptos to buy or purchase. On the other hand, you could just simply buy into an index, which will, with its index rebalancing mechanism, you are essentially investing in the whole trend. That way, you should be safe and you should make a profit in the long term. Although it may not be spectacular, like 100, 1,000% return as you would see for some individual cryptos. But on the other hand, you also will not face the same, the deep risks that's involved in that high level of return. Now, for the lack of discipline part, this is where it becomes interesting, because JCF now has the design that we actually put all the profits of the fund, which is the increase in the fund's value, into what's called a dividend pool. And by moving everything into a dividend pool, which nobody can touch, okay, we're actually creating a sort of a public fund or a public trust of sorts, where dividends are paid back to other participants regularly, which we do currently on a monthly basis. We've changed the design from yearly now to monthly basis. So every month you will receive 1/4 of whatever assets that's in the dividend pool as your dividend payments, and that serve as a form of passive income. Now, how is this protecting retail investors? Because again, we talk about the timing issue of entering the market too late or exiting it too soon. Now, with the entering market part, because all the all the profits of the fund stay in the dividend pool, it actually, will grow continuously if the trend continues to grow. On the other hand, because you have no access to the profits now, you only receive the dividends on a regular basis. So even if the fund is at a loss, for example, you are actually compensated by your dividends. And you are also getting back your profits on a more granular, regular cycle of time. So you won't have a chance to just spend or waste it all or invest into some wrong vehicles. One example many people may know is that, for many of the lottery winners, after they have won some big cash, a lot of them, there's research being done on this, a lot of them actually fall back to their wealth level before they win the lottery. And the reason is very simple, because they don't have ideas how to manage that amount of wealth or money. They simply just spend it, recklessly. So to avoid this, and this also happens to retail investors, once you have made some profit here, you might just, become bolder and more ambitious and try to, use the profit and gain it big time. But oftentimes what happens is you invest into the wrong vehicle or do it at the wrong timing and then lose all the profits you've gained previously. But with a design like JCF, what happens is all the profits are kept into the public trust and you are only receiving it back, on a monthly basis as a form of passive income. So if you really like to learn more, please go to our official website, jcf.world, and please feel free to register and join us. If you like our content, please also share with friends and families, or press like us on Facebook, or subscribe our YouTube channel. So thank you very much, and we'll see you next week.